Hi everyone, it's Alex here at Session Capital Research. Welcome to our Growth Investor Pro weekly webinar. It's not in fact Monday the 4th of November, it is in fact Thursday, the 7th of November, and it's currently just after 4:15 Eastern for the benefit of the tape. Okay, I'm to do a slightly different webinar today. We've got lots of new folks with us, so welcome all. We'll post this as a recording later on, as always, and we'll run on a live and open mic basis, as always. So once we've done our disclaimer in a moment, we'll open mics, and then, as always, if you've got questions, points, comments, things you agree with, disagree with, anything at all, open the mic and shout, or type questions or comments into the webinar platform here. Or if you're a Growth Investor Pro full-tier member, then you can use the Rocket chat room and type questions and comments into there. The thing I want to talk about today is, now what? Right? So there is a general sense that, everything just changed, and whichever, side you had in the election, if you had a side, you have a pretty strong opinion as to what just happened, and you probably believe that everything just changed. And in some regards, I'm sure it has, but for markets, nothing's changed. We're in the same market system that we were last week and last year and a decade ago and a century ago, and the methods that work to invest and trade successfully in the market are the same today, yesterday, last week, a decade ago, possibly not a century ago, I don't know, but certainly a decade ago. And I'd like to talk through that because emotions across, a whole lot of people are running very high at the moment, and that's an anathema, in my view, to making money. Way to make money is to be very calm, thoughtful, reactive, not try to anticipate things, not try to overlay your opinion on things, but just look at things as to how they actually are. So I want to run through basically reading the market as a topic. I'm not going to do too much in the way of particular security analysis today, but we will look at a few things. We'll look at the 10-year yield, the VIX, the S&P. I'm going to talk a little bit about sector rotation. I'm going to use semiconductor as an example, and we'll touch, if there's time, on energy as well. As always, live Q&A, we'll do that at the end, but again, all the way through, if you have questions, comments, just shout. It's much better on the way through to discuss things as they come up rather than waiting to the end. So let's do our disclaimer, after which we'll turn microphones on. So disclaimer's on your screen right now. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or solicitation of offer to buy any securities. Nothing in the webinar is intended to be investment advice, nor should it be relied upon to make investment decisions. Session Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stock, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Session Capital Research. Session Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, let's get mics on. Okay, so microphones are on right now. Okay, so on the topic, did everything just change? Okay, I think it's really important right now, more important than most times, to just don't forget real life, but from an investing and a trading perspective, even read the news at all. I would step completely away from it, take no notice of it. Wherever you go, be it Twitter, TikTok, mainstream media, wherever it might be, it is raging charged full of emotion about whether what just happened was a roaring victory or a crushing defeat, depending on your perspective, or a curio, or who knows. It doesn't matter. What matters is understanding what it is that moves markets and how to try to predict where markets might go and how to profit from that accordingly. The method that we try to use here at Cestrian is essentially a sort of red pill, see the matrix for how it is, step out of what you believe to be reality and look at what's actually reality, nihilist sort of method. Don't believe in anything, don't believe anything you hear, watch, see, there's a hedge fund manager telling you something on Twitter, they're unlikely to be there to help you. If some stock is being touted as the greatest thing ever, well, it might be, but that's probably not to your benefit that you're being told it right now. If somebody's saying a valuation is attractive or unattractive, doesn't matter. Valuation doesn't drive stocks. You have to, in my view, adopt a, nothing is real. The only thing that's real is price and volume method. I don't think that's any different now to a week ago, to a year ago, to a decade ago. And to the extent that any reality does matter, the interlocking forces right now are you have an avowedly pro-business administration. Their intent will be for equities in general to go up. You also have an interventionist administration, which has a stated agenda of applying tariffs. We don't know how that will apply or to whom or whatnot, but we know that's probably coming. And we have a market which is still in bull mode some 2 years after the bull started. Now remember, nobody believed this bull market in late 22. Everyone was still incredibly bearish. It took everyone by surprise. But if you're a subscriber here, you won't take it by surprise because you know that the methods we use helps you see reality for what it is. And you could see that those markets were going to start to move up in the fourth quarter of 22, and they've kept going. We make mistakes like anybody else, but direction of travel, we called it really nicely at the COVID lows. The 2021 highs were a bit hasty in calling the end of the bull market. We were a bit too bullish in the first half of 22, but we got it smack on right at the second half of 22, and we've had a pretty good run since. And all those methods that we use work just as well today. So what I want to lead on today is, let's look at charts, right? Let's forget what's in the news. Let's forget about valuations. Let's forget about this stock or that stock being hyped. Let's just look at some charts and how they work. I want to start with a 10-year yield, the bond yield. I'm going to switch that on right now. The reason to use this, by the way, is to show you that securities move in somewhat predictable ways. So this is the yield on the 10-year bond, and you could, although it's a yield, you could think of it as the price of a security. So if the yield is rising, as you know, the price of the bond is falling. So this is a recent low, 18th of September, where the yield was at 3.6%. And the important part isn't really the actual yield. The important part is the moves relative to prior moves. And the best way that I've found, I'm 5 years into a professional investing career, massive transformation for me from being a good investor to being much better than that, was starting to really become expert at technical analysis. And in technical analysis, the only thing you're looking at is the security itself as a closed system. If you do technical analysis correctly, you take no notice at all of outside factors. You don't care what the weather is, who's in the White House, what just happened on the news, what Jay Powell said, which company reported earnings, doesn't matter. You look at each security as a closed system. There's many technical analysis systems that work. We use, as you know, the Elliott wave and Fibonacci system, and then for securities, you can't do this with the yield. Obviously, we also look at a volume by price analysis to try to see where there is heavy buying for accumulation, where there is low volume but markup, and where there is heavy selling for distribution. And so price and volume is really all that we focus on. Hey, Prasad, do you have a question?
Hey, Alex. So maybe this question can wait. You can answer it a little bit later as you're covering this end of this treasury. But my question was like, any options or any kind, not options, any kind of securities that we can use to short 10-year treasury?
That you can use to what, sorry?
To short, to get to take the opposite direction, like to bet on the treasury rates falling, 10-year treasury rates.
Well, in bonds, if you use the levered ones, TMF is the 3 times long ETF, and TMV 3 times short. Those are the ones I use. But can we come back to that if that's okay?
Sounds good.
Okay, great. Okay, so this is the yield here. Okay. Again, it doesn't matter what the yield actually is. It matters about the move relative to each other. So this is a recent low in September, 3.6% yield. We get an initial move up off those lows. which peaks up at 3.8%, and then a so-called retrace. And all a retrace means, it means retracing your steps, moving back towards the place where you first came. And these retracements, as they're called, generally, roughly, can be measured as a percentage of where they came from. So these Fibonacci levels here, this here says, well, the yield retraced to between the 0.5 and the 61.8% retrace level of this move up here. And so in this system, the Elliott wave Fibonacci system, we can say there's a good chance that's a wave too low. And in this pattern, it's just pattern recognition. That's all it is. This isn't looking at anything in the real world. It's not looking at the inflation rate or the expected inflation rate. It's not looking at yesterday's bond auction. It's just looking at the pattern itself. In this pattern recognition system, you say, well, once you've hit a wave too low, you're probably in a wave 3 up. How far do wave 3s go? Well, they have to clear the wave 1 high. They usually get to the 100% extension of the prior wave 1. They often get to the 1.618 extension of the prior wave 1, and they can go much higher. This one peaked at almost exactly at the 200% extension of that prior wave 1. Again, that happens to be 4.1%, doesn't matter what it is. It then put in a wave 4 down, and it was a shallow wave 4, not quite a 38.2 retrace, and then we're in what's potentially a wave 5 up, where the wave 5s terminate. Doesn't matter if it's a yield or the S&P or Apple stock, system is the same. Wave 5 typically terminates somewhere between the 0.5 and 78.6 extension of wave 1 to 3 placed at the wave 4 level. Now, why does this matter? Well, it matters because let's say that you thought that yield had bottomed there, because if you zoomed out a bit, you would see that we had previously, we'll do this another day, but basically a big A, B, C correction from the highs that were struck in October 23. And you would see a bottoming formation here where the yield really can't fall below its triangle, it can't drop below 3.6. It then moves up and then it puts in a wave too low. You might think, well, look, yields are going to climb. And you might think, well, I'm going to ignore the news that says about inflation and rates down and all of that. I think the yield's going to climb. Why? Because the pattern says it is. So let's say I decide I'm going to go short bonds. So if the yield's going up, price of bonds is going down. So right down here, particularly at this wave too low, you might say, well, look, I'm going to buy me some TMV if I like the levered ETFs, or I'm going to short TLT. And you might say, well, how far can this go? And you might hold TLT short or TMV until such time as the yield reached that 1.618 extension. Then you might say, well, that was a good run. I'm out. I'm going to sell. And you might sit back and you see the yield climb a bit higher. You go, okay, I sold a bit early. That's all right. I can just wait. And then you might see a wave 4 low put in there, and you might try and play that wave 5 again. And you could do that successfully with no regard to what this security is, to what this is pricing, to anything on the TV. This system, if you backtest it, if you apply this method to all major liquid securities, has worked for decades, a century probably. And that's not different today. So my sort of absolute fundamental message today, no pun intended, is that more than ever, I think one has to ignore reality. Don't get caught up in the heated debate about, the big thing that just happened, what's going to happen. No one knows. Not even the incoming administration knows, because whilst there might be a clean sweep in the US political system, you have a bond market, and an equities market, and a future market, and an options market, and a bunch of central banks that all have various moving parts in the global financial system, and no one knows how they're going to react. It's too complicated. So I don't believe you can map out what's going to happen to stock A or bond B by studying reality. Charts are the best proxy for what's going to happen using pattern recognition, where what you're looking at is the thing itself as a closed system. Let's look at the S&P with that in mind. So I'm going to zoom out for a minute and take a longer view here. Now, we look at this chart a lot, and this chart projects from the COVID low in March 2020, and here this is a longer time frame. We're looking at months and years here, but the pattern is the same. So we have a wave 1 up that peaked at the end of 21, a retracement down, a wave 2 retrace that troughed at the 0.5 retracement, and then you could have said around here, as we did, and we were far from alone, but anyone that used this method would have said at late 22, I think the market's going to move up now. Why? Because of this pattern, and it has. And this bull market that has surprised so many people, well, it hasn't been a surprise to anyone that used this method. And if you've been a subscriber here, you won't have been surprised. Again, I'm not claiming any special genius. That's not it. It's just the method. So this method would tell you that, well, how far can SPY go? It will say, well, look, it's definitely going to give you a new all-time high, which it did. It cleared for that last 480 odd. And it would say, oh, look, probably SPY is going to go to, let's call it 650 before it hits any major rollover. And there's a chance, just a chance, that it goes to 830. Now, we can all come up with 104 reasons why it's never going to hit 830 ever in the history of money ever, and that's just not going to happen, and that's fantasy, and there's no point even thinking about it. But you know what? We're probably wrong, because equity indices in particular, particularly the S&P and the NASDAQ, do trend up over time. Bad things happen from time to time, bear markets happen, but do trend up over time. And these targets here, called a chicken bull target and a bully bull target, aren't pulled from thin air. They're just standard extensions of past behavior. So again, my opinion, my strong opinion, best way to study and predict securities prices, at least the big liquid securities, not true for small stocks, but the big liquid institutionally traded names, is learn a price pattern. I like this Elliott Wave and Fibonacci system, but you don't have to use this. There's many other technical methods that work. But this is a superior method, in my opinion, to invest and to trade than to try to project from what you believe to be reality, what you believe to be valuation metrics or the news, into where securities prices might go. Because none of us know what is going to happen. You don't know what's going to happen if you sat in the middle of the White House, and you don't know what's going to happen if you sat in the Bank of Japan, and you certainly don't know what's happened if you're sat at a trading screen all day. Some people have more inkling than others, of course, because some people are more of a price setter than others, but there isn't any one individual who is a solo price setter. All we have is the interlocking systems in front of us that tend to move in somewhat pattern-driven ways. If we zoom in on the S&P, and let's look at recent behavior. So this is a daily chart, and this tracks from the August the 5th low. And this is tracking really nicely. Look, so regardless of the time frame you use, the same sorts of systems work pretty well. So look, here's the August the 5th low. It was a major low, we know that. We know that it was a spike low, and the S&P raced out of that bottom, and it put in a wave one high at the end of August, and then it retraced. Now again, it dropped to not quite, but nearly the 50% retrace. And if the S&P had gone down to the 61.8 retrace at 530, or if it had even gone down lower to the 78.6, or even at a push, slightly more specious argument this, but at a push, the 88.6 retrace, you would still have said, well, that down there, that's a wave too low, up we go. Now, as it happens, it didn't drop that much, it dropped to here, and you would have said then, we did, off into a wave 3 up. And then if you have some knowledge of the pattern system, you would say again, well, okay, well, let's say I bought SPY at 539 down here. How high can it go before rolling over? And you'd say, well, I'm pretty sure it's going to get to 564 over that wave one high. You would say, I'm reasonably sure it's going to get to 593, which is the 100% extension. And you know what? It might get to 626 before it rolls over. Not in a direct line, not tomorrow, not without some volatility. But this move here, which will be variously attributed to the expected policies of an administration which is yet to take power, where no one knows truly what they're going to do, not even the incoming administration. Really and truly, that's just pattern systems playing out. And if you look at this gap here, this is the run up, this is pre-election, this is post, big move up. You might say, well, how could you work out whether that was going to happen or not? And my answer for this is, learn to use the volatility index, the VIX, as something to help you with your investing and trading. This all sounds difficult. It isn't. Okay, anybody can do this. if you can add up, if you can think about modestly complex systems, you can do this. And another key thing with financial markets is don't ever let anyone tell you that you have to be some sort of quantitative genius to do it. You have to have 13 PhDs or a computer the size of a room. You don't. You just have to learn the language. Trading, investing is exactly like learning a language. Duolingo could run a course on trading and investing. It's just a language. You are learning to read signs and symbols, and linguists will tell you that languages are just made up of signs and symbols. So how could you have predicted this move up here? And is this a party political thing? Is this because there's an incoming Republican administration, or would this have happened with a Democrat administration, or what? Well, what we'd said is that pre-election, everything looked poised to move up, and all the pre-election tension, there was a lot of it, would suggest that the market was ready to move down. But all the charts that we looked at, and you'll remember this from previous webinars, look bullish. And I remember saying, well, it's the fact is the charts say that it looks like tech's going to move up, energy's going to move up, indices are going to move up. It looks like everything's going to move up. Why would that be? And a lot of the answer you can find in the VIX. Now, people get themselves all tied up in knots about the concept of volatility, and you can do that if you want. My own view is to treat the VIX very simply. Jay Urbane, who runs two great services for us, an option service and an AI risk service for us, you can find those on our website, really helped me understand the VIX. And he described it as, look, you just have to think of it as demand for S&P 500 puts. Okay, and when you think about it that simply, and in the back of mind, that it doesn't cover zero DTEs and all that, but just as a simple concept, just think demand for S&P 500 puts. What does that mean? Well, it means when the VIX is rising, it means that demand for S&P 500 puts is rising. So somebody, could be investors, could be market makers, who knows, but enough people are buying enough puts to raise the VIX index. So when the VIX is elevated, when it's making a series of local highs, as it did here in September and October, and again just before the election, this here is the August the 5th event, as you know, then what does that mean? It means you've got a spike in put buying. Now, generally, markets tend to move up. Right, so if you're going to pick a direction for markets, for equity markets, you'd say the dominant direction is up with some contra movement. So in general, it's much easier to lean bullish in markets than it is bearish. As far as you zoom out, if you zoom out, to the dawn of securities trading in the Rialto market in Venice, in the 1500s, you would say that equities have been bullish since then, with a few counter-trend bear markets along the way. And so in general, people get themselves, all worried about things, which when the event passes, in general, the event tends not to be as big a deal as they thought it was. Now, options people will give you, all kinds of complicated takes on this. They'll call it, an IV crush, volatility crush, a whole bunch of other things that are, not my world. But put simply, people get too stressed about things that turn out to be not that big of a deal. And this happened with the election. So pre the election, we said here, look, end of October, you've got the VIX at a local high here. And I remember saying, and again, it's not claiming any particular genius. Anyone who studies this would have said exactly the same thing. You can go and find people all over Twitter saying it. This is not me claiming special insights here. This is just a method statement, which is to say, probably the VIX is going to drop after the election. Why? Because the event has passed and then certainty is known. And what I said prior to the election was, it doesn't matter who wins, because when someone wins, there will be clarity. I thought it would take a bit longer, frankly, to reach an outcome. It didn't. It was pretty quick in the end. But whoever had won, there would be clarity. And therefore, most likely, people then, breathe out, stop worrying so much, know that there's, try to figure out which direction things are going to go in, and release or reduce their demand for S&P 500 puts. And that's what happened. So you got this huge drop in the VIX the morning after the election, and mechanically, once the VIX drops, drop in demand for puts drives the S&P up, and there's your corresponding gap up the morning after the election, and it carried on today, as you know. Where the S&P goes, not always but often, the Nasdaq follows, and on this occasion we saw a particularly strong move in the Dow. Now, frankly, largely a tech index, and we also saw a strong move in the Russell. So all equity indices gapped up pretty much as a consequence, an almost mechanical consequence of the reduction in investor worry, event worry. Now, so how could you have known that the S&P was likely to move up after the election? Well, would is the best way to spend time working out who's going to win the election and what their policies might be and what that means for the equity market? I mean, try that if you like. I think that's a really hard way to try to make money. If that works for you, great. Keep going. Me personally, my view is when there's a whole lot of stress around an event, after the event, volatility tends to collapse. Demand for puts for S&P 500 tends to collapse. When that happens, the S&P tends to move up, and that tends to drag up other things in the equity complex. The question now is, well, when might the S&P hit resistance? And I think you can answer that again by looking at this simple chart. And this doesn't tell you the exact answer. What it tells you is where might it hit resistance. We know that equities don't go up in a straight line. We know that even if we think that the S&P, that the SPY is going to go to 835, and it really could do, it's not going to go there in a straight line. And so depending on what our proclivity is as an investor, we might think, well, listen, I'm busy all day. I'm happy to leave my money in an S&P tracker. And you know what, if it wobbles around a bit, but it gets to 650 on the SPY or 835, that's great, I'm happy. Brilliant. Don't worry too much. If you're more active because either you like to be or because you found that by being more active, you can beat the S&P, and anyone can do that. It's not as difficult as everyone says. As long as you study and have the time to react, anyone can do that. You might be looking at saying, well, when's the next resistance going to come for the S&P? And I think you would look at this chart and you would say, well, look, where's this wave 3 going to run to? If you look at our market note on our website today, we said, look, 593 is an important level. That's the 100% extension of wave 3. Now, as it happens, it closed over that today. So if it turns that into support, meaning it drops back from above and holds 593, that's really bullish. Next stop, 605, 1.236 extension. Not that many wave 3s in the S&P stop at the 1.236. They tend to keep going. So the next place where we might see resistance for the SPY is up here at 626, which not coincidentally is this 1.618 extension here. And so if you were trading SPY, not minute by minute, but if you were trading it, daily, weekly sort of time frames, then you might think, well, look, what's going to happen next? There's some chance that this gap here gets filled, maybe. So you might see a pullback down into here. It would probably find support around here, 576, and back up. That could happen. But if it just keeps going up, what you know is it's not going to go up forever. At some point, it will roll over. It might roll over now. It might roll over 605. It might roll over 626. But again, in my view, if you want to work out where the S&P, we're using SPY here, but of course you could use futures or any other index play, then this is the better way to try and study it, not by working out, well, what did Powell just say? What are rates going to be in a month? Where's inflation going? How do tariffs bear on that? You can't get there from here. But pattern recognition like this, and again, there are many systems, this is just one system, pattern recognition will help you. Look at the NASDAQ, same story. It's pretty much the same chart. Here is the August 5th low, a 1 up, 61.8 retrace, wave 2 down. NASDAQ is more volatile than the S&P. So the amplitude of the waves is always greater, and the time frame within it happens is usually compressed. more volatile on both the y-axis and the x-axis. We then have this wave 3 up. It too is sort of hovering around that 100% extension at 511, but it closes to 513. Next stop, it gets 526, it gets 551, or we might see a close of this gap here. And so the reason to use these systems is because you can constantly watch and you can say, look, I know that I'm still in a bull market. Why? Well, prices just keep going up. The worst thing to do at the moment is to be net short and just stuck in the way of this ongoing, freight train that's just running everything over. You know you're in a bull market, so the safer positioning is always long. If you want to be careful, if you want to hedge, if you want to try and get short gains along the way, or you're looking for a pullback to buy into, then charts like this can help you work out when to do that. Let's talk next about sector rotation. But before we do that, I'm going to take any questions, comments, anything at all on indices, on the chart patterns, on not reading the news, or on the VIX. Anything we want to cover on that stuff, folks. Prasad, you're on.
Hi, Alex. So just on that previous question, so from the charts, do you think 10-year Treasury is going to roll over down? What's your general thought?
Well, that is an interesting question. I do, and I do, and I tell you that this is the whole nature of the exercise here. Because if I look out the window, I would say no chance, right? Bonds are going to keep falling. Why? So this is. Let's step away from the screen and let's think about reality for a bit. And if you looked at reality and say, well, bonds are going to keep going down, in other words, the yield's going to go up. Why? Well, Powell just told you inflation isn't beaten, right? And he's cut rates into an inflationary environment. The World Bank or someone said today global GDP 3% for the next few years. That's pretty good. They said it wasn't, but I think that's pretty good. Reducing cost of money, strong GDP, tightening labour market. So, wages are likely to rise. If, again, let's look at the real world, the incoming administration has told you they're going to reduce the labour supply by deporting a lot of people. So that means wages are going to go up. So on all those fronts, you go, well, inflation is going to go up, so bonds must keep going to go down, right? That's what you conclude. And so me personally, I'm fighting that analysis, which I'm trying to ignore in the back of my brain, with this chart, because this chart says, yeah, yields are going to drop, and therefore bonds are going to go up. And if we look at the TLT charts, the TLT, as you know, is, and by the way, I have a small position in bonds, I have a long TMF position, just a tiny position, just a single unit position, which is now, I'm going to say a point or two underwater is all. It was a bit more than that. And I'm thinking about whether to add to it. So here's TLT on the daily, right? And this is where I think TLT is. So this is the end of a correction. TLT is long bonds, 20 plus year Treasury bond ETF. Doesn't track perfectly to the 10-year yield. It's measuring a slightly different bond, but it's a bad proxy. So here is the April low in TLT, wave 1 up, 78.6, wave 2 low, wave 3 up, 2.236, wave 3 extension, a drop down to about the 0.5 retrace from the look of it. Yeah, not far off for a wave 4 low, and the wave 5 up that terminates in this termination zone of the 0.5 to the 78.6 extension of wave 1 to 3, place of the wave 4 low. And then we get a big correction, A, B, C correction. And that C looks to me like a 5-wave correction. 1, 2, 3, 4, 5. So it's a righteous ABC correction. Zoom in.
So Alex, just to clarify, like I keep getting confused between yields and prices of securities, right? So basically, the 10-year Treasury rates increased, and because of that, the TLT has fallen, right?
Correct. Yeah. So the yield goes up, the price of the bond is going down, and the TLT is the ETF. It reflects bond prices. So if bond prices are falling, TLT is falling. If bond prices are rising, TLT is rising. So yields and bond prices are the inverse of one another. So if yields are going to fall, if yields fall, TLT will rise. If yields rise, TLT will fall. Okay. So here's TLT. Right. This is the low that was struck on the 6th of November. Okay, and I think that that's put in a wave 2 low. This is on the hourly chart, right? So here's your wave 1 up. Here's a 2 down that dropped at exactly the 61.8 retrace. So that's an institutional trading sign. That's a piece of language, a piece of vocabulary that's saying good chance that's a low. And I think this is a wave 3 up now. So I have two parts of my brain. Okay, the brain, part of the brain I know I should listen to, but sometimes hard to listen to, says that's a wave 3 up. Okay, that is going to go. Let's measure it. Let's project it. And this happens to be TLT, but it could be anything. How far is that going to run? That's going to run. TLT's at 91.35 now. I'm going to say on the hourly that's going to run to 92 maybe, and then drop back down to 90 and move back up again. And if I zoom out onto the daily, then I'm going to say, this is still in wave 1 up on the daily. It's yet to reset and move up. But I'm thinking, if on that shorter term time frame on the hourly, if I've got a 1, 2, and a 3 up here, these things aren't perfect fractals, but they do tend to repeat at different scales. So if it's bottomed on the hourly, it's moving up. So good chance that in a large degree, daily, weekly, monthly, good chance it's going to move up. So I'm sat thinking, do I want to add to my TLT TMF position? And the chart says I should. Now, me personally, I'm actually struggling with this one, contrary to everything I just said about ignoring reality. I'm thinking there's a hell of a lot of evidence in reality that says bonds should keep falling. And then also I know that Druckenmiller is massively short bonds. Do I really want to go against all that weight of evidence in front of me? Chart says I should. So what's the answer to that? The answer is, in my experience, the chart is much more right than one's own interpretation of what you believe reality to be, because you don't know what reality is. You don't know what's going to happen to inflation. You don't know how bonds are going to react to inflation. You don't know what Druckenmiller is actually doing. You don't know what Powell is actually doing. None of us know this. Only Druckenmiller himself and Powell know these things. And so the way to deal with that is use the chart and manage risk. So let's say that right now you thought, I'm going to go long bonds, I'm going to buy TLT, I'm going to buy lots of it. Well, what would you do? You'd place a stop loss, right? So you'd say, well, I'm going to buy lots of TLT, but I know that if TLT drops below 89, let's say, I was wrong. I thought they were going to go up, and they didn't, they go down. And so if I place a stop loss down here somewhere, I can't lose that much money, a couple of dollars a share, not the end of the world. From 91 to 89, not the end of the world. And so there are certain points on charts that are great places to buy securities. Wave 2 lows and early in a wave 3 are great places because you've got plenty of potential upside and not much downside if you set a stop loss in a potential in a sensible place. And again, we've talked many times about the benefits of either stop losses or hedging. There's many different ways to do it. But in essence, if you go, look, below 89 or so, something bad happened, I was wrong. So what could you do? You could sell the TLT, eat the loss. If you like to hedge and overhedge, you could buy a lot of a short bond ETF and ride it down, the gains of which would outpace the losses in your long bond ETF. Lots of ways to do it, but the thing you have to be aware of is to go, right, what's the price I care about? Price I care about is, I thought that was a bottom. If that's not a bottom and it drops below that, I was wrong. Let's recognize I'm wrong. So the other aspect of all of this, and again, a reason to not get caught up in the emotion that's going on outside, the workplace, with our friends and family, on Twitter, all these places, is it doesn't matter. Only price matters. Who cares, right? If I'm wrong in TLT, I'll know because price will fall below 89. Not because someone at work tells me I'm insane and inflation is going to go, nuts. And if you've seen how much eggs are lately, that's irrelevant. The only thing that matters is, does TLT fall below 89 or not? Treat these things as a closed system, is my view. Who's up next? Paloma, hey, you're on.
Yeah, hi Alex, good evening.
Good evening.
Just briefly, I made some cash on single stock names in the last days, and
I believe you did rather well.
I did. I had Palantir,
Congratulations.
and it was a blast. AppLovin was up 45% in one day. I sold it
That's
on.
nice. Nice.
44%. I couldn't believe it when I saw it after market. It was I said, why didn't I put everything, all the cash in this one
Yeah, of
stock?
course, yeah. I should have put it all on black, right?
Yeah, exactly. So anyway, so I'm sitting on this cash and I'm looking at obviously, S&P, Nasdaq, but the one that I totally missed because I just get bored of it the same as you do is the Russell.
Yeah.
After the rally we've seen these days, is it worth putting money to work in Russell or just keep putting into S&P and Nasdaq?
Well, I'll tell you what I think, and it's only my view. It is, hang on, let's get the Russell here. Just lost my markup for some reason. Okay, so this is the Russell, right? And we've looked at this chart a bazillion times. It looks to me like it's going to hit that all-time high of 244, and it looks like all this, 2 years worth of accumulation down here is going to be paying off big for whoever was buying down here, particularly if they're down here in the 160s, 180s. My own opinion is the reason that these systems work so well in the S&P and the Nasdaq and everything else is because if you're buying the S&P, if you're buying the Dow, this is DIA here, the thing you're buying is the finest companies in the world, right? You're buying 500 of America's finest companies. So the most perfect capitalist country on earth, it's 500 best companies. Or in the case of the Dow, 30 of its best companies. Or in the case of the Nasdaq 100, 100 of its best companies. And so your underlying risk isn't that high. It's not going to go to zero, right? The S&P is not going to halve tomorrow. Let's say you had a terrible sustained bear market. Could it halve over the course of, a year, 2 years, 3 years, 4 years? Sure, of course it could, but it's not going to do that tomorrow, and you'll have time. The flakier you get, the more volatile the underlying stock. So if we were to look at so SMCI, let's look at that. It's a great example. Supermicro. Okay, now, we talked about this a lot at the time, and I'd said that I completely missed this one on the way up. And here's what the stock did. Let's just remove all the markings for a second. Okay, so here's what the stock did. It did basically nothing from inception, forever, moved up into 23, retraced, and then put in this absolutely colossal move from some accumulation in the 30s up to 122, and then it's given it all up again. And I missed this move, and I wasn't looking at it. And when I did look at it, I didn't much like what I saw. I saw a white box company with 20% gross margins that's just putting together bits of other people's stuff. That was a relatively small business, and that had almost no intellectual property because all the IP is in the NVIDIA chips that it buys. And so my view was that is not something I want to chase, and I didn't. And obviously, I could have made plenty of money on the way up here, but my view was there's a good chance that this company does something like this. Why? Because it's not that good of a company. Now, obviously, there's accounting issues and auditor issues and the rest of it, so the decline has been pretty spectacular, and I certainly wouldn't have expected it to be like that. But the poor underlying quality of the issuer means that you get this volatility. This is a meme stock. GameStop looks like that, AMC looks like that, so on and so forth. So for me, the Russell clearly isn't like SMCI, but it's a bit more like SMCI than is the S&P or the Nasdaq. And so I myself don't think the risk is worth it, to be honest. I think, well, if I can buy a hugely liquid instrument, SPY, QQQ, or the associated futures of options, that our underlying issuers are 100 or 500 or 30 of the finest companies in the best capitalist country on the planet, why would I want to own 2,000 mom and pop shops instead? I don't know. I can't answer that. Now, I know people, get all obsessed with small caps, but I don't think that's sensible. I think that's some sort of desire to be associated with a gang or a cult stock or something. It doesn't make any sense to me. It's not the most sensible way to make money. The most sensible way to make money to me is the S&P and the Nasdaq, and to a lesser extent the Dow. That to me is where the finest risk reward is, because you can either sit and just own the S&P. You use the Warren Buffett method of just reinvest dividends, and over time, all of history, it's gone up. It might go down next year, I don't know, but it'll probably go up after that if it does. Or you can layer different methods of compounding on, right? You can trade in and out using the chart system we've looked at, or other chart systems. That's a form of compounding. You can use structure through levered ETFs or options or futures to get some additional power through the security. But all the while, the issuer risk you're taking, the underlying company risk, is really low. Whereas with the Russell, you're taking much more issuer risk. That's my view. So I as it happens, when I've traded the Russell using TNA and TZA, I've done all right. It's pretty good actually, but it's never been relaxing, and I haven't done it for more than a year. I mean, we talked about this last year, which is I got this quite wrong with the Russell in 23. It sold off more than I was expecting. Had a horrible unrealized loss in TNA down here. Went massively levered long TNA. Did really, really well on the way up, and sold at the end of 23, and breathed a huge sigh of relief, and I never went back. and that's fine for me, because it was not fun. It worked. It made money. It was a good set of trades overall, but it really was not fun, and I didn't want to go back there, and I haven't. I find the S&P and the Nasdaq much more relaxing personally.
Thank you. Or I'll keep doing single stock picking.
Well, you're doing great, so congratulations.
Okay. Thank you.
Good one. Prasa, do you have another question?
Alex, yeah, just a question on that 10-year treasury. So, which instrument do you suggest doing TLT, or is there any 3x of the 10-year treasury that we could buy that mirrors TLT?
Yeah, the 3x is TMF long and TMV short.
Got it. Okay. I had one single stock. Is it something we should do it at the end, or?
No, we do it now.
So actually, couple. So Intel, INTC.
Yeah.
I think you predicted it spot on when you said that it's going to gap up. I think.
Did I? Good. I don't remember that. But... Okay, well done me. Okay, hang on. Okay, here we go.
So I think a couple of webinars before, I think you said it's very likely going to fill the gap, right? And it looks like it's heading towards it.
This is a great example, right? So should you buy Intel stock, right? Everyone knows Intel is a disaster, right? If you look at the fundamental numbers, it's awful, right? It just eats money. Revenue growth is declining. It's behind technically. It can't manufacture the things it should manufacture. The CEO is rather bizarrely tweeting biblical passages on Twitter, which that's a new one on me. It's a mess, right? I'm long Intel. I've been sort of thinking about adding to it. I sort of wish I had and I haven't, but I've probably got enough given the risk profile, but I've been thinking about adding to it. Why? For this reason, because that's a lot of volume down here. Just look at these gray volume bars down here. This is after the big dump on earnings. This is after, everyone knows everybody knows it's a disaster, right? That's the narrative. But oh, look, right? One, you've got the volume. And two, we see them in a bit. Oh, look. Doesn't that look like a wave one and a wave two, right? So here's clearly a low, right? It tried a low here, bounced, made new lows, no more sellers, right? So there's your low. And let's get rid of that. Let's measure the move. Okay, there you go. Again, that 50% retrace. And look, it's even better. This is on the daily. Okay, so September low, wave one up. So from 1850 to 2468. And then look how often it tests this low here, right? So it tests 2159 or so, on the 3rd of October, on the 16th of October, on the 23rd of October, and again on the 31st of October, and then it just went rip. And if we zoom in a bit more, and again about how these patterns repeat at smaller and bigger time frames, I don't think you can call them technically fractals, but they certainly have some sort of echoes as you change time frames. Look, this is where that bounces, and oh look, there's on a smaller time frame a 1 and a 2 and a 3, and we measured that, and we will find, I'm pretty sure, and I haven't done this before, but I'm pretty sure we'll find that this is moving to technicals as well. So we have a 1 up, a 61.8 retrace, and now on this time frame we've got, you go, a 200% wave 3 extension on the smaller time frame. We zoom back out again, and so I would say that, yep, there's a good chance that gap gets closed from 26 to 28. And the really interesting thing, I think, let's get back to reality for a minute, is Speaker Johnson said 2 or 3 days ago, pre the election, he said that, you know, if they won, they were going to can the CHIPS Act. And that's the, as you know, the Federal Funding Act, which has basically been pouring a river of money into anyone that's in the business of reshoring semiconductor manufacture back to the US. And I thought that was nuts. I mean, I thought, well, you know, you do have this strategic competition with China for fabrication. You know, US success in semiconductor does depend on reshoring it. You know, all the stated aims of the incoming administration, and we know now that they are the incoming administration, all the stated aims are absolutely aligned with reshoring semiconductor manufacturing. So why the hell would you can the CHIPS Act? And so I suspect that if you look at the price reaction, you know, post-election, Intel shot up. It shot up. Now, I would conclude from that that the money that arrives in Intel's coffers won't be called the CHIPS Act. It will be called the something else thing. But money will arrive. How do I conclude that? You know, because I've studied Mike Johnson's body language? No, because the price went up. You know, everybody knows, anyone with a big account knows that Intel cannot possibly survive without a big capital infusion. Where's that capital infusion going to come from? It's not an equity raise in the market. It's federal, you know, slush money. So that river of money, you know, today is called the CHIPS Act, tomorrow will be called something else. But I think that river of money is coming because it has to. You know, the only way you can manufacture advanced semiconductor devices in the US is in TSMC-owned plants. That's going to be problematic if Taiwan becomes a target. Or at Intel's yet to be completed, yet to go fully online fabs. So I'd say it's a pretty good bet that a lot of money is going to come Intel's way, and the stock price won't wait for, you know, 18 angstrom chip yields to be at the acceptable level. The stock price will run up in anticipation of that. And if they manage to switch on a brand new fab and the yields get to be okay, the price will go up again on that. Prices run ahead of reality. So I feel pretty good about Intel. I'm still thinking about adding, maybe I will, maybe I won't, I don't know. I'm certainly not selling. I think Intel can work out.
So yeah, I think so. The Intel got kicked out of Dow a couple of days ago. So
Yeah.
I think 2 days ago, 2 or 3 days ago, I think that's what scared me, and I was like, okay, let me just dump it. Why? There's going to be a lot of money managers doing the rotation of the symbols, so the price has to go fall. So I just dumped it at 23.5, and then now it's like in 3 days, 2 days, it's like up, right? So from this point, like, you know, I guess the overall, you know, long term.
Let me pick you up on that, right? I'm not going to criticize you for it because we all do stuff like that all the time, right? But this is a great example, right? And so I'm not. Don't take this as criticism. It's not meant as such. Okay, this is a look. It's completely rational, isn't it, to go, well, I know that when something falls out of an index, I know that index funds have to sell it, right? That's a mechanical consequence. So if I know that StockX is falling out of the index, it's rational, isn't it, to sell it because I know everybody's going to be selling it. That's completely rational. And so in a world where you invest and trade based on the outside world, that's absolutely the right decision. And, you know, we all do things like this all the time, right? All the time. Like, for the reason I haven't added more to my bond position is because I'm thinking, well, you know, inflation, Powell, blah, right? Whereas I should just look at the chart. But in fact, this is the issue with the news. Okay, when do you suppose that the largest owners of Dow index funds knew that Intel was going to come out of the Dow? When do you suppose they came upon that knowledge? Do you think it was at the same time as the rest of us? Of course you don't think that, right? When did they know that? A week ago, a month ago, 6 months ago? Don't know. But was it on the day that it hit the news-wise? Absolutely, categorically not. No, right? So it's more likely, in my opinion, that the reason that the thing dumped in the first place around here was that's when people knew that it was going to be coming out of the Dow. That's when the selling was. Maybe this big spike here, right? Maybe that was distribution there. Huge spike over this period of time. Maybe people knew it was going to fall out the Dow back in April, right? And so therefore, when it falls out of the Dow, well, anyone who was going to sell has already sold. And you know that, right? Because look, there isn't any more selling below $18. And so there's a bit of a retrace here. When was the Dow news? It was last week, wasn't it? It drops back a bit, but it only falls back to the 38.2 retrace. It's not even a very deep correction. Why? Because it's only people like you and me who are selling. Right now, I didn't sell Intel on that occasion, but I've done just that sort of thing on other occasions. Right. So again, please don't take it as a criticism. This is a method point. I've done this myself many times, but because it's only people like you and me selling, we're not going to move the market. Right. It doesn't matter how much money we might have ourselves, we're not going to move the market in Intel, right? Because the bigs already moved the market. And therefore, there's no willing sellers in any volume, and therefore it doesn't take much buying for the thing to move up. And this is why technical analysis trumps reality, trumps news every day of the week, in my opinion.
So at this point, what do you suggest, like in terms like, do you think we should wait a little bit for the stock to take a breather to re-enter, or just what are your thoughts?
I don't know. I'm thinking about it. I'm thinking about it. Yeah, I'm thinking about it myself. I mean, in general, we're in a bull market, and waiting for pullbacks is often a sort of fruitless strategy. A different strategy, and you have to decide what to do. But a different strategy is, if you want to re-enter, okay, don't consider not writing a huge check now, but write a small check, right? And so if it goes well, write another small check, and then another small check, and another small check. Whereas if you just write a big check now and it falls down, then all of us will go, oh hell, I just wrote a big check and now I'm down 10, 15%. Hell, I knew I shouldn't have bought it. I knew I should have waited for a pullback. And then our mind is a mush, right? And then you don't have a low pulse and a low blood pressure and a calm state of mind. You're all stressed, and that's not good. So another method says, well, this is a going up stock. This is probably in a way 3 up. So, gradually buy a bit. If it goes well, buy a bit more. And if it goes well, buy a bit more. Nothing wrong with that. Waiting for a pullback in a bull market, that's what everyone on Twitter is doing, right? They're all waiting for a pullback in the NASDAQ. Well, good luck with that. You might get it. But people who, quote, wait for a pullback, when it comes, they go, oh, my God, the thing's falling. I can't possibly buy. I think it's a flawed strategy for all but a very few, in my opinion.
Got it. And what is the ceiling like? I guess in terms of the short terms, termination zone, or like, what do you think is kind of the ceiling for the price
on Intel? Yeah, let's zoom in a bit. Let's have a look. I don't know. Let's have a look. It's a good discussion. This. It's a big help to me, by the way, because I'm. There you go. There's one I prepared earlier. Okay, good. 31. There you go. Why 31? Because look, here's the correction that bottoms out down here, 6th of September, and then you've got that one up. We talked about this, 2 down, tested multiple times and holds. 1.618 extension would be 31, so $31. And if it doesn't quite make it there, 100% extension, 27.59. And if you'd like to set stops, where would you stop be? Your ultimate stop would be somewhere below 18. It's quite a big fall from now, so you could put a stop at, I don't know, 20 or something, below the 61.8 retrace, or you could put a stop at, at 24, below that wave on highs. Lots of ways to control risk, but I would say the upside reach is probably 31, and another way to look at it would be, well, I reckon there's a good chance of hitting 28, 29, because that will close that gap there. But that would be my guess, 31.
Got it. Thank you.
Good
Hi.
question. Thank you.
So I know you don't cover left LYFT,
No,
but just on the technical analysis, can you do a chart for that on the short term?
I can try, but I mean, I know nothing about it.
So they're just valued at 1x their FY25 revenue and 8.6x the FCF for FY25. So, and
Okay,
this group,
I'm literally, I don't think that matters. I mean, so what, right? What's the right valuation? Who knows? Okay, what could you say about this? Here's what you could say about this. You could say that, okay, you could say this, that here is, there's a low, and you know it's a low because it was hit March 23 and it was retested May 23 and then it moved up. And okay, this is a bit of a tricky one, this, because okay, here's two ways to look at it.
is it possible to put the volume bars also to the right, just to kind of see?
Yeah, let me do it in Transpire. I think it's easier. Okay, it's on the daily. What happened in March?
So yeah, the Tesla's robotaxi event announcement came, and the stock got a beating because of that robotaxi stuff.
Okay. Why I think this is difficult is because, well, the chart's a mess, right? So and you don't tend to. This is what I mean about the S&P and the Nasdaq is charts in the S&P and the Nasdaq don't tend to be a mess. They tend to be orderly and tend to be a bit less guesswork. Because what would you say here? Let's say you called that there the low, and then you could say, what's that? Must be an 886. Okay, so you could say this, right? That's a one up and that's a two down. It's a big, deep 88.6 retrace. And you could say, now we're in wave three up and, that might go to, the moon. $30, right? Maybe.
30.
But I don't love the fact that there's a level in November 23. It's retested here. So I think a preferable way, if it was me, would be to do this. Still horrible. Is to go, okay, well, there's a one and a two. What's the market cap price that of Lyft?
About $7-8 billion.
7-0.
No, $8 billion.
Oh,
Just
yeah. I don't think you can do technical analysis on small caps. I really, really don't. Because, I mean, I don't think this is a good method for small cap stocks. I mean, it's one of the reasons we stopped covering so many small caps. I just don't think it works. Because look, you've gone from a 1.236 extension to a 2.236 in a gap. Right? The S&P and the Nasdaq, or even SOX X or Nvidia, they don't do that. And so all this sort of freaky behavior, I think it's really, really hard to chart these things. So my answer to that is that the method I use for securities analysis, I just don't think works with stocks like this. And I say it's one of the reasons why I really don't trade anything like this myself, or really, really stop doing it in the service, because I just don't think it works. I'm sure there are methods that do, but our method doesn't. So I haven't got a clue.
Also, the volume, right? A volume bar seems to show that, at this price, which is like $18, the volume is really thin so far, right? So it is that's kind of a red sign, right? To kind of sell your stock right now, right? It's
Well, somebody was hoovering it up here, right?
right. Somebody was collecting there, yeah.
Somebody was collecting there, exactly. Yeah. So I don't know. I won't opine on that one. It's beyond my pay grade. But yeah, that's a difficult one, I think.
I see. Good to just kind of take your profits, right? If you've ridden from 13 or 14, right? I rode it from 13.
Yeah. No, I mean that's your call, but I mean these smaller caps scare me personally, and yeah, when there's profit, it's much more ephemeral than in the bigger names. So yeah, anyway.
Got it. Thank you.
Welcome, great question, Prasad. Thank you. Right, folks, we're over time. We've got time for one last point. If anyone has any before we wrap up. Anyone else got any points, questions, anything?
Socks, please.
Oh yeah, socks.
Because I sold everything. I panicked a little bit, with all the China tariffs and the CHIPS Act and whatever. So I just sold it, and I want to come in again, but I want to make sure that it's still right.
I think socks is pretty good, to be honest. I tell you what I did with that, right? Which is I went through. I mean, I've disclosed this, but I went through all of the stuff I owned and thought, okay, what are the obvious things to get hit with tariffs? Why don't I just get out of those now and just not bother worrying about the risk? So ASML I sold because it's a Dutch business that exports most of its stuff to the US and China. That's obviously going to be a target for attention. Why take the risk? Get out. I only have one unit of it. I took a tiny loss on it. No problem. This is SOXX. This thing looks like it's still under accumulation to me, right? So here's the all-time high. I mean, isn't that accumulation? Right, 1 up, 2 down, sideways trending, big volume. I mean, it's clearly not going to get there anytime soon, but there's a sort of trajectory, kind of. Never sure if these things work on the x-axis really, but that's not a dumb timetable. Where's that? January next year, yeah. It looks like accumulation to me.
Okay.
And
Good
it's
enough.
so far. Yeah, it's so far below the all-time highs, and it's still the most beaten up sector, and yet all the hyperscalers told you they were spending rivers of money on semiconductor capex. So I think it's okay personally. I think the semiconductor sector is going to get more volatile. If you think back to the last Republican presidency, semiconductor went up, but it was volatile, and you would get, and I think we're going to get more volatility in the next couple of years because there'll be more tweet bombs, just like there were last time around, and so that will hit individual stocks, and it will sometimes hit the indices a bit, but that tends to be just short-term volatility. And I think semiconductor is particularly liable to that because you've got the whole China export control thing, Taiwanese manufacturer, all that. So I think we'll get more volatility, but I don't know. I'd say it's accumulation personally. I mean, so for disclosure.
Sorry, would you get rid of TSM because I own it on a single stock basis?
Me, yeah, but I scare easy on that stuff. So I mean, I don't own it, but I sold it too early. And if I did own it, I would have sold it yesterday, and it went up today. So yes, but I probably would have been wrong. Because again, if you for everything I've just said about chart analysis, what I like to do personally is just remove big binary risks, right? So ASML is a great example, which is in a world where globally tariffs are going up, non-tariff barriers are going up. Do you really want to own a Dutch business where its primary listing by capital is in the US and its biggest customers are in the US and China? Does that sound like a brilliant idea in a post-GATT, post-WTO world? Not to me, it doesn't. So answer for me, get out, right? ASML chart looks pretty good. If we look at it, it's up today. So on the face of it, you'd say wrong decision. On the face of it, you would say, stop worrying about reality, trade the chart in front of you. That's the way three up, blah, blah, blah. But for me personally, I think, well, what I care about is I don't want any stress or worry in my investing and trading. I want to keep my resting pulse rate at 60, my blood pressure low, my breathing rate low. I don't want any stress. So I'm deadly serious, right? So
Yeah.
I don't want any stress. Why do I want to own a Dutch business which capital's in the US, its customers in the US and China, in a world where I know for a fact that globally trade is re-regulating, right? It's the opposite of the liberalization path we saw from, the 80s through to the 2000s. It's doing the opposite. So why do I want to own that obvious sitting duck and it's a monopoly, right? So in EUV. So if I am a government, I think, yippee, I see me an easy scalp here, some free money, right? And I go and have a go at ASML. Why do I want to own that stock? I don't. So for me, I can reduce my own personal investing and trading stress by not owning ASML. And so TSM for me would fall under that category. I trimmed NVIDIA today for the same reason, which is something bad happens to TSMC, something bad happens to NVIDIA because they manufacture the vast majority of their stuff there. Whereas if I own SOXX or SOXL, I've got the risk spread across. Again, if it's SOXL, I can still get great returns through the leverage structure. So I'd sooner solve for returns with security structure than with issuer risk personally. So yeah, for me, I wouldn't own TSM, but so far that's been the wrong decision. And when I sold it, I sold it too early. So I'm not claiming any Oracle level intuition here. A lot of the time I'm looking to solve for my own stress levels, and what I want is no stress, and because we all perform best when we have no stress.
Yeah, I'll put a stop loss. I think it's a good idea.
Yeah, that's not a bad idea.
Yeah. Okay. Thank you very much.
Great.
Alex.
Thanks, Paloma. Great questions as always. Right, folks.
Alex,
Thanks.
Just
Prasad,
follow up on that.
make it quick, Prasad. We're 15 minutes over time.
No. Just a minute. Yeah. So SOXL. Do you think any risk with that? Doing SOXL instead of SOXS because it's 3 times levered, right? Is there any time decay and stuff?
Of course I do. That's the point.
Sorry. What is it?
I think there's colossally more risk with SOXL than SOXX. It's a 3 times daily levered product. So there's massively more risk. Yes.
No, just in terms of the semiconductors move, right? But just assuming that the semiconductors direction keeps moving up, right? Because it's a levered product, is there more risk in terms of the time decay and other stuff?
Yes, it's massively more risky. Yes.
So it's better to just. But you do buy TNA, right? Which is like 3 times levered.
I use the 3 times ETFs quite a lot, but I use them because I've learned how to hedge. And I've got my account set up so that I can hedge, in a heartbeat with no capital constraints or no worries or anything like that. And I can do it pretty much 24 hours a day, not quite, but almost. And so I have very low stress levels. But I would not, personally, I would not touch a 3 times ETF if I didn't, A, know how to hedge, B, have my account set up so I could do it in a heartbeat without capital constraint. I wouldn't do it. That's just me, right?
Got it. Okay.
I mean, paper trade it first, I might suggest.
Okay.
3 times ETFs are a really great way to go broke if you go sort of all in on them. They're a fantastic instrument, a superb instrument if you learn how to use them. But I personally would not pile in. It took me, I tell you this, right? In 2018, I started paper trading TQQQ and SQQQ, and I couldn't do it. Right, I couldn't do it. I couldn't work out how to do it, and it took me until 2022 when I went off and learned a bunch of things, and the penny dropped, and I went, aha, now I can do it. So it took me 4 years of scratching my head and practice and theory and working out how to do it. And since then, it's been brilliant. It's like a money printing machine. It's terrific. But when I started, I couldn't do it. I paper traded. I made a horrible mess on paper, and it would have been worse with actual money.
Got it. If somebody who doesn't hedge a whole lot, then definitely this is not a good idea, seems like it, right?
Well, it's a great idea if you learn how to do it, but you've got to learn how to do it.
Got it. Okay, sounds good.
Okay, right, we've got to go. Thank you, everyone. Great webinar. I'll post the recording in a couple of hours once it's in HD. Any more questions that come up, hit us up in all the usual ways. So YouTube comments, questions in chat, however you like. There's a Ask Us Anything button on our website, the bottom page of our website, bottom links on our website. You can hit us up there, anything you like. Thanks everyone, and talk to you all soon.